Hello, and welcome back to another episode of me grinding every single day until I discover a trade model that makes me millions and millions of dollars. And today was a pretty lackluster, kind of boring session, which is reasonable because we have FOMC later this week. We have FOMC on Wednesday. It's Monday. Last week was a huge one-sided weekly candle, so I really didn't have high expectations for today. I anticipated today to be lackluster, and I mean, it was. We zoom out, take a look at this range. Pretty boring, right? Doesn't really go anywhere. So I had two attempted trades. Now, before I get into anything else, I will go over my little process that I'm going through right now. So let's get into that right here. Okay, so right now, I am just recording my observations and price action. I'm not taking any trades. I am not attempting a top set account or anything. I'm not even demo trading. I'm literally just looking at price action and recording my observations, saying I would get along here. Like, everything is hypothetical. I'm not pushing any buttons right now, because the second you start pushing buttons, that's when you add emotions to the equation. So right now, just leaving the emotions out and just focusing on reading price action. That is it. That's all I'm worried about right now. But tomorrow, I actually am going to start demo trading for the first time, because ICT left a new step in the process in his 2024 mentorship. He basically said you just start demo trading to see how it feels. You gotta feel that rush of anxiety and just look for low threshold objectives, where you would take your first partial, and that's it. That's all you're looking for. So I'm gonna try doing that tomorrow, because when I go throughout his live streams at the end of every session, he is literally outlining exactly what I was thinking. So I'm thinking exactly how he is thinking. So that's how I think I'm really ready to finally start demo trading after doing all these observations. I have all these entries. I've recorded, 55 observations in price action over 4 weeks. And I think I'm finally ready to start actually pushing a button, because I have a good idea of what I'm looking for. I have a trade model. Here's my trade model. So from 9:30 to 11, I'm looking for this specifically in price action. And from 7 o'clock to 8 o'clock in the morning, I'm looking for this specifically in price action. So really, I have two opportunities within a trading day, one before the 9:30 open and one after the 9:30 open. And I will go over both of those in today's price action, because both of them occurred. Now, I noticed that my trade models are actually developing in real time every single day, which is a good feeling. There's no reason for me to feel any kind of FOMO at all, because I know that even if I weren't to take a trade, I know my model is going to be there tomorrow. But coming into today, I had my first observation at 8:14 in the morning, and I'll go over that. And that was using this trade model. So today I was looking for a hypothetical long, although it did not align with this model. What aligned with my model is the sell scenario. So basically, I want to sell what is already in motion on the 15-minute time frame. So I want to see price engage a higher time frame premium rate and or liquidity. I want to look for an SMT divergence, and I want to look for a breaker formation and clear higher time frame order flow, like an easy read on that higher time frame order flow. I want it to be very obvious what the market is reaching for, and I want intel from the London session that suggests we potentially have a high of day in. I just want clear information that something has changed on the higher time frame, and now it is reaching for a objective below the marketplace, which I'll explain in today's price action that happened perfectly. And if I see an SMT during the London session, that's added confluence. That's good information that I could use. So going into today's price action, if I start on the 15-minute time frame, we can see I have this SMT marked out. I'm just going to delete this because it's pretty irrelevant by now. But we have an SMT at the Asia high. So that is my first piece of information that I can use to frame a sell scenario after 7 o'clock in the morning, because 7 o'clock is the start of the New York morning session. So if I pull up ES right here, go to a 15-minute time frame, look how messy it is today. It's pretty disgusting. I mean, this is what we can expect, right? We have FOMC later this week. But if I look at the Asia high, you see how, I'll just mark it this way, make it very clear, very obvious. So this is that same high on both the NASDAQ and the S&P. Now, if I extend that out in time, we can see that ES is running that high, NQ is not. So what is that? That's a Kraken correlation. That indicates that NQ is not willing to deliver to that high. That is a sign of weakness. And look at the reaction that we get after that, right? Look at this whole price leg lower. So whenever we see a crack in correlation, that indicates the shift from one side of the curve to the left. So if you think in terms of market maker models, this SMT indicates the end of the buy side of the curve and the start of the sell side of the curve. And here we have our, here we have our original consolidation, right? Here's our little clean, perfect box of price action. So there's your original consolidation, and then we have our drop down. So if I'm being honest, when I saw this information today, I was expecting price to reach up in here post 9:30, but obviously we didn't get that. So we have that clear information from the London session. We have an SMT at the high of the day, and look at the order flow on the 15-minute time frame. Look at all these strong down close candles. And if you look, what do we see here? We have a bearish breaker on the 15-minute time frame, which is exactly what I outlined in the little diagram that I had, right? We have a high, a low, a higher high, and a lower low. So what is that? A bearish breaker. So if I see this information from the London session, then I am simply looking to get aligned with what is already in motion on the higher time frame. And you can clearly see that the order flow is heavy, it is weak, so then I have to think, what is price reaching for? And if we look lower, well, number one, we have all these relative equal lows down here. So there are sell stops resting below these lows, and we do take that out. So we have an objective here reach. Now below that, what else could it reach for? Now I marked out this wick right here, and I was thinking consequent encroachment of this wick, we could potentially reach down into that. We also have a new day opening gap down here, and Friday daily low. So with this information that I was seeing in the London session, it was very clear to me that the order flow was heavy and the draw on liquidity was Friday's daily low. So that is where I was anticipating price to go. But I got my first long observation at, what time was it again? Let me check. At 8:14. So that was my first observation where I took a hypothetical long. So I had all this information, but I still looked to fade that, which is just not smart at all. So here's the thing about 7 o'clock, I would say up until 8:15. This is what I've noticed through my forward testing. From 7 o'clock to 8:15, I am not looking to catch the start of an entirely new move. I'm simply looking back to what happened in the London session and just getting in sync with that. From 7 o'clock to 8:15, this is a rule of engagement that I've created for myself for my trade model. I am not looking to catch the start of an entirely new move. I simply want to get in line with what is already in motion. And we can clearly see that the draw is obviously Friday's low. So I faded that rule. And of course, it didn't play out. Now, if I simply got in line with what was in motion, then that would have played out for, let's say I hypothetically got my entry at the 15-minute sell side imbalance. That would have played out for targeting Friday's low. 68 handles, almost 70 handles. And I can even target the daily inverse fair value gap or the 15-minute buy side imbalance, sell side inefficiency, or 20 to 30% retracement relative to last week's range. So a lot of downside objectives, but I mean, I was basically just fading that rule. So that's why this observation was incorrect. Observation, not a trade, because I'm not pushing any buttons. But we can see that 15-minute imbalance, this was a perfect opportunity for a turtle soup. We could have sold short above this high, selling to these buy stops. We also trade up into this order block. We don't test the open price, but we do dig up into those up close candles. And then here's literally my ideal entry model on the 1-minute time frame, where I have a breaker formation. I literally look for a breaker, that's it. And the first inverse fair value gap that I see, that's my entry. My limit order is going there. So we have a high, a low, a higher high, and a lower low. Once we disrespect the open price of this consecutive series of up close candles, that's a change in the state delivery. Now the market is seeking sell side liquidity below old lows. And that's clearly what we see here. And then look how the market trades right back up into the first inversion fair value gap, and it rolls over. So you could have gotten a short here or here, multiple opportunities to get short. But this is literally just getting in sync with what is already in motion, which is exactly what you do from 7 o'clock to 8:15 in the morning. That's exactly what I'm looking for. If I see something that is clearly in motion, the order flow is very easy to read, I know exactly where price is going, then this is what I want to do. I don't anticipate the start of an entirely new move. That's what I wait for at 9:30. 9:30 is the time element when I can anticipate a move against the higher time frame order flow, which is what I did today. And it played out to my first objective, but not my other objectives. But I'll get into that. So, I mean, that was basically just my mistake here. I knew what was in motion, but I tried to fade that because we were trading underneath these relative equal lows right here. So I thought maybe we could see a reversal, even though I knew that the draw on liquidity was obviously Friday's daily low. So tried fading that, and it did not work, which good, perfect, because that just supports my thesis that from 7 o'clock to 8:15 in the morning, I don't want to fade what is already in motion. I just want to get aligned with that, and it's easy and it's simple. I'm not looking for the start of an entirely new move. I'm finding a clear objective that price is reaching for, and I get in line with that. It's easy. So I tried a hypothetical long on this inversion fair value gap right here. So that was my hypothetical long, because here I have a bullish breaker, right? So I have my long setup on the lower time frame, but if you look and see what is that higher time frame doing, we're not reaching for higher prices. We're drawing towards Friday's daily low. And given the time element, this is not a time where we expect the start of an entirely new move. Price has an objective, and it's going to reach that at the 9:30 open or before, and it does that. Literally at the 9:30 open, we dive into Friday's daily low. So I've noticed that when there's something in motion from the London session, it reaches its objective at or just before 9:30. And this is exactly what happens, right? 9:30 opens, we dive right into our objective. And then that starts a new move. And that's when we can actually anticipate some kind of a retracement against the underlying order flow on that higher time frame. And that's usually when we see the start of an entirely new move. Now today, the London session actually did form the high, and this was just simply a retracement. We didn't see any continuation in this price run. But this is simply why this observation didn't work. I saw my entry model, but I was just fading what I already know is a common characteristic within the daily range. So I'm actually glad that I got it wrong here, because it just supports that notion even more that between this time period and this time period, I don't want to be doing this, which is perfect. Now I have more evidence to support that claim. So now tomorrow, do you think I'm going to go in here trying to fade what is already in motion on the higher time frame before 9:30? No, I'm simply going to get aligned with it. So you have to appreciate the value that your losses bring you. They bring you a lot of insight about yourself and the market, okay? You can't go in the market trying to avoid failure, because failure is actually how you learn. So when I was starting to do these observations, I was in there trying to lift up my ego and protect myself from getting it wrong, because I thought if I got it wrong more, then I viewed that as a lack of progression. But ironically, the more that I lost, the more that I learned, and the better I became. So I became a better trader by losing more, which is the paradox, right? You would think that the more you win, the better you are. But in the beginning, you really actually want to seek failure. You want to take that loss. You want to feel that discomfort, feel how it feels, and simply extract the lesson from it and become a better trader because of it. So a big level up in my trading journey was simply appreciating the value that losses bring. That was a huge paradigm shift. So I'm actually seeking failure. I'm not trying to avoid it in any way, shape, or form. I invite it. And here I was like, you know what, let me just test this long, because it'll probably be wrong. And if it's wrong, well, then I simply study what went wrong, you know? So it's a huge paradigm shift. Appreciate the value that your losses bring, and you will become a better trader because of it. Seek failure. Do not try to avoid it. Get uncomfortable. Allow yourself to be uncomfortable. Put yourself in these positions. Feel what it feels like to be wrong, and learn from it. That's all you can do, right? Okay, so at 9:30, here's another characteristic within the daily range that I've noticed tends to lead to a easy bias, an easy narrative, and an easy setup. So between 9 o'clock and 9:30, we usually see the algorithm just mark time. When it's marking time, what we see is time distortion. It's simply held in the holding pattern, meaning it's not going to go and create a new range. It's simply just going to trade back and forth, sideways, barcode, whatever you want to call it. That is time distortion, where it just does this, just trade sideways, right? So the algorithm is marking time. It's in a holding pattern. It's not going anywhere. It's going to stay in this range until it is the right time to move. That's why it's called time distortion. It's not moving right now. It's waiting for a certain element of time to begin moving again, which is why time is the most important element, because if it's not the right time, then price isn't going anywhere. See, if I were to take a trade at 9 o'clock, it's not going anywhere. I have to wait until the next element of time, which is that 9:30 equities open. And you can see as soon as 9:30 starts, boom, we start running again. The algorithm starts spurring for liquidity, right? And we dive right into our objective that was from the narrative that was already in motion from the London session. So everything just makes sense. But anyways, when we see time distortion, which we usually do between 9 o'clock and 9:30, today it started around 8:45. This usually creates your little perfect box of price action for a market maker model. And then you simply see what side does it take first. What side does it reach for first, because the opposite is your bias. And you can see that literally plays out here. So for market maker models, I don't know too much about them, but ICT covered them a little bit in his 2024 mentorship. But he simply said, what starts it is this perfect little box of price action. So you simply just look for your little box of price action, right? Which would be here. And then you wait, what side does it take first? What side does it take first? So we can see that here, we run the sell side liquidity first. So what's next? It's going to reach for the buy side liquidity, obviously. It goes from one side of the marketplace to the next. The market literally plays tag. It first tags the sell side, now the other side is it, right? Tag the sell side, next we're going to run to the buy side. It's really that simple. It's very simple logic. Takes one side of the range, it's going to go to the opposing side. So here's the little perfect box of price action, and initially at 9:30 we drop lower. So without using any other context, I could literally just use this right here to frame a narrative and a bias post 9:30. We drop lower, okay? We run the sell stops first, so what am I thinking after that? I'm thinking we aim for the minor buy side liquidity above this high. So I'll just annotate this. So without any other context, I can easily frame a narrative right here, but here was what I was thinking. So if I go to the weekly chart, we can see that last week's range is a large one-sided weekly candle. And on Friday, if I drop down to the daily, we just had this contract change, ignore that. On Friday, Monday, Tuesday, Wednesday, Thursday, Friday, so here we lacked a TGIF. A TGIF is simply a 20 to 30% retracement back into the weekly range when we had a one-sided weekly expansion move, right, which we had. We had this huge expansion move, but because the move was so largely one-sided, we lacked a TGIF on Friday. So if we don't see a TGIF on Friday, we can expect that move to be deferred to the following Monday, and we can expect a 20 to 30% retracement on Monday. And we got that. So I marked out 20 to 30% of the weekly range. Drop down to a 1 minute again. I marked out 20 to 30% of the weekly range, and I was simply waiting for where could price potentially, what is an area of interest where price could reverse. And if I go back out to the 15, I could see that I have this low here. This is all underneath Friday's daily low as well. So I have these lows are relatively equal, and I have this large imbalance here. And this imbalance aligns with a 20% retracement on the previous weekly range. So because we didn't have a TGIF on Friday, I can expect to see it on Monday, and we get that. So this 15-minute imbalance aligns with the 20 to 30% retracement on the weekly range, as well as the daily inverse fair value gap. So I'm speculating that this is a point of interest where we could potentially see a retracement. And we can see that, look where the body's on the 15-minute close, right? We all close within this 15-minute imbalance, and look at them respecting a 20% retracement on the weekly range. Look where the body's closed, right? The wicks can do the damage. We have to permit the wicks to color outside the lines, but look where the body's closed. The bodies tell you exactly what price is doing. So there's that. There is one piece of evidence to support the trade. We reach the 20% retracement of yesterday's range, so that's a potential reversal point, right? And it's inside the 15-minute imbalance, as well as the upper quadrant of the daily inverse fair value gap. Now back to the 15, I was also thinking that we could frame a reversal underneath Friday's daily low, underneath the previous day low, to then trade higher and run out these very clean, smooth highs up here, right? So obviously we didn't get up there today, but this is still a level that I need to keep in mind throughout the rest of the week. We could reach up into there later this week. So this clean, smooth area of price was ultimately what I was aiming for, and maybe even the previous day high. I was thinking we could frame a reversal off the previous day low to take it to the previous day high. Now, obviously we didn't get that. We kind of just hung around here, didn't really do shit, which is fine. I was still able to pull equity out of this trade, which is something that I had to realize. I was kind of hard on myself because price never reached up to those highs, although I was still able to, price still reached my first objective, just never reached back up there. And I felt like shit because, I mean, I saw this move. I thought the real move of the day was lower. We never reached my objective. Price didn't do what I was expecting it to do, and I didn't take that well, which revealed a lot about me. But here's where I was looking for my potential entry. So 930 drops lower. We initially run the sell stops. I'm viewing this as the Judas swing, the fake move. What side of the marketplace is offered to the public first? The wrong side. So right out the gate, we run lower. This is the Judas swing. Look where we trade into. 20 to 30% retracement on the previous weekly range inside of the 15-minute imbalance, inside of the daily inverse fair value gap. For me to take a trade, I have to wait for an imposing imbalance to be inversed. So we have this imbalance right here. We trade through that. If we look below the marketplace, you can see this buy side imbalance, sell side inefficiency. Look how we wick into the lower quadrant, and boom, we immediately repel price lower. And we do not respect this bearish fair value gap at all. We just slice right through it. So here I have two indications of strength. Two right here, but we had this huge initial drop down lower at the open, and at the time the order flow on the 5-minute time frame was pretty heavy, and I wasn't necessarily comfortable with getting along. I wanted to see some more information. But I have this and this supporting my trade idea first, especially seeing this reaction off of 20% retracement, right? And then here's first presentation. So first presentation is simply the first presented fair value gap after 930. And what I've noticed through my forward testing is a lot of very, very, very good setups come off of first presented fair value gap. So mark that out, extend it out in time, and I wanted to see some more information. So I wrote down in my journal before this occurred, if we can inverse first presentation, close above it, then I want to see price trade back down into Friday daily low, wick off of it, and then accelerate into here first. And then ultimately my objective was these smooth highs here, and then a terminus would probably be up here. Obviously never got up there, which is, it's fine because I was still able to pull some equity out of this trade, right? My first partial was secured, and that was good for 38.5 handles. So first partial is fine. I would probably roll my stop loss to break even. Cover cost. Once I see all this action right here, because we're simply just accumulating above this high, we literally get stuck on an old imbalance right here. So we were never able to traverse this imbalance, and we just rolled over. So that was the reasoning behind this trade, all these levels down here. And once I see first presentation inverse, trade up, trade above it, close above it, dip down into it. Look at this very strong reaction we have. So this is an algorithmic signature. This is exactly what you want to see. This is exactly how you want to see price react to an inversion fair value gap if you're bullish, and as well as a bullish fair value gap. So look how we just wick down into the lower quadrant. If I were to drop a fib on this, that we barely come just shy of the lower quadrant right there. And we, boom, acts like rocket fuel, sends us higher immediately, exactly what you want to see. Beautiful reaction. And then we accelerate to the minor buy side liquidity above. So that's my first partial. And then obviously this didn't work out. Rolled over and stopped the remainder of the trade out, which is fine. I was able to pull out some equity. And I was very hard on myself. I'm not sure why, because I mean, it still delivered to my first target. I was just like, oh my God, I got it wrong. It didn't do what I wanted it to do when it just rolled over. So I learned a lot about myself and an emotional trigger in this exact situation. So whenever price kind of just hangs around, it's very slow, sideways, choppy, whatever you want to call it, super lethargic, and then eventually just rolls over and stops me out, that pisses me off a lot. So that is something that I have to work on. I have to develop a coping mechanism for that specific situation, which is right here. So what do? You have to know everything about yourself, right? Because you're going to have emotional barriers that arise in your trading, and they are going to prevent you from seeing the success you want as a trader. So you have to know exactly what they are, exactly what they look like, and you have to develop a coping mechanism for them. So I have this page called Introspection. Introspection with the intent to achieve self-control. So basically all I do is just mark down situations where I feel some kind of emotion. Like here I have the emotion recorded, like frustration, boredom, tilt, anxiety, frustration, doubt, whatever, right? Feeling, what did I feel inside me that told me that that emotion was present? Because what is feeling? Feeling is a conscious awareness of vibration. That has nothing to do with emotion. That has something to do with something else. But anyways, we know that we are feeling an emotion because we have a physical feeling inside of us. So when you feel emotion, you physically feel something inside of you. So this feeling is just kind of my way of describing what that is. And that feeling that you physically feel inside of you tells you what emotion you're feeling. So I know what anxiety feels like for me. I know what frustration feels like for me. I know what doubt feels like for me. So I have the emotion, the feeling, and the trigger. What caused all of it, right? Because there's a situation that causes all of that. And then in this case, it was a slow grind to stop out where the market kind of just hung around, did not fulfill my objective, and then eventually just rolled over and stopped me out. So slow grind to stop out or retracement against me, where I will literally screenshot exactly what it looks like, right? Because it's going to happen again. You have to know exactly what that situation looks like. It's going to happen again. So you can prevent yourself from doing something stupid the next time it comes around, right? And so I've noticed that when this situation happens, I'm literally just going to turn the fucking computer off. Like, I'm done. I'm walking away. I'm not coming back. So 100% lost conviction. This trade cannot go over to the 723 imbalance, which I outlined. Sideways forever, annoying, frustrating. So that's exactly how I felt. And then I just screenshot it because it's going to happen again. And then I do a little journal review. Now, I know you can't read my handwriting, but that's okay because I can read it, and that's all that matters. My handwriting is shit. Yes, I know. You don't have to tell me. So I just describe the situation. I describe how do I feel. I describe what does this reveal about me, right? What does this tell me about me? And then I just do a little reflection on how I can cope with that emotion. So I had to remind myself that I didn't necessarily do anything wrong. It just didn't work. It just didn't work to my terminus, but I was still able to pull equity out of the trade. Now I get to study what went wrong and become a better trader because of it. Kobe. So I watched this reel on Instagram. It was a sports psychologist, and he was talking about how Kobe, in I think one of the most important games of his rookie career, he missed like 4 shots that would have won the game for his team. And after the game was over and they lost, he had his head in his hands and he was sitting there on the bench like, you'd think like, oh man, he must feel like shit. He must feel terrible. He literally just sold the game for his team. And so then an interviewer walks over to him and asks him, Kobe, you must feel absolutely terrible right now. And then he responds, no, I don't feel terrible. I was running through those scenarios in my mind and figuring out exactly where I went wrong, which is the perfect mentality that you have to have for your losses. You have that emotional aspect. Any loss you take, you have that emotional aspect that comes with it, right? You might feel like shit. You might feel like a failure. However you feel after you take a loss. You have to overcome that, simply get through that emotional barrier and study. Literally, what did I do wrong? Where did I go wrong? How can I become better because of it? And that's the right mindset that you need to have about your losses. And once I started doing that, it got a lot easier to take losses. Now, obviously, I'm still not good at being incorrect. At times, for the most part, I am a lot better. But at times, I can still, feel an emotional reaction. So when I felt that emotion today, I literally just laid on my floor and I just stared at the ceiling and I allowed myself to just sit on that feeling and feel how it feels, right? Because you have to desensitize yourself to taking losses over and over and over again. You have to feel how it feels. You have to get uncomfortable. Put yourself in these uncomfortable situations because they're going to happen over and over and over and over. So you have to desensitize yourself to that feeling. So I literally just sat on my feeling, looked at my floor, and just sat on the emotion. Like, this is how it feels. Now, you don't want to do anything to amplify the emotion. Just let it sit inside you. Just let it dwell inside you. Just let it be there. And eventually it'll dissipate. It'll go away. And then you pop right back up and you study exactly where you went wrong. And that's how you handle a loss. So that's my way of going about losses. And I honestly, today was a good session. I learned a lot about the market and myself, and a lot of characteristics about the daily range and my trade model. And I'll be back at it tomorrow, demo trading for the first time ever. So until then, see you later.